Freedom, peace and love, wisdom, grace and joy, purpose, hope and light. We'll rise, touch the sky. It's not always easy, but it's easier here. Just take my hand, you've got nothing to fear. It's not always easy, but it's easier now. How far will you go? It's up to you now. Easy, it's easy, it's easy, it's easy, easy, it's easy, it's easy, it's easy. When you believe, when you can see, the power in your hands can set you free. Freedom, peace and love, wisdom, grace and joy, purpose, hope and light. We'll rise, touch the sky. It's not always easy, but it's easier here. Just take my hand, you've got nothing to fear. It's not always easy, but it's easier now. How far will you go?
Hello, everybody, and welcome to this webinar, which is all about ETFs. My name is Carl, for those of you who I haven't had the pleasure of meeting yet or interacting with. And it's always great to host these webinars. And it's always wonderful to have our very own Veronique's song that she wrote playing as we wait for all of you to join. There's some super talented people working at Easy and also in the community. So today we are joined by Nerina Visser, who many of you will be following on social media. Many of you would have seen or heard her when she speaks, whether it's the Salter Awards and a range of other financial platforms. Nerina is definitely one of the smartest, the most eloquent, and the nicest people in the financial landscape. And I'm delighted that she has agreed to speak to the Easy community. So welcome, Nerina. It's great to have you with us.
Thanks, Carl. And remember, flattery will get you everywhere. So I'm now in your hands.
No, that's all factual. So Nerina, I know, is passionate about many things. And when you do see her at a function, you must ask her about her other interests, because one can easily be confused and thinks it's only ETFs, because there is nothing that Nerina does not know about ETFs. And she plays a couple of roles. So Nerina, today you're sort of officially joining us as ETFSA, and you and your colleagues have been doing some fabulous things there. You launched your own first product. Before then, you didn't have your own product, and you launched your first one the end of last year. How's that gone?
Yeah, great. Thanks, Carl. Yes, for many people, this might seem a little bit almost counterintuitive, but I think what we experienced, and we're certainly going to talk about actively managed ETFs today. ETFSA certainly has been a solutions provider to our clients, and our retirement annuity fund has been running for almost 12 years, and we have a number of very good products and solutions and funds in the retirement annuity fund, but they were exclusively only available to RA fund members. And from that perspective, the introduction of actively managed ETFs allowed the opportunity for product providers like ourselves and like Easy ETFs, in fact, to bring product to market that are not purely just tracking an index. We'll get to more of that detail a bit later, but it allowed us then to take one of our RA fund portfolios and offer it as a balanced fund, a multi-asset portfolio. And over $500 million AUM on that one. So certainly been some good traction, good growth in terms of that. Lots of interest and really good to see that happening.
Nice. So how the session is going to work, Nerina's going to do a short presentation. And after that, I'll be asking some questions. If you want to ask questions, please make use of the Q&A facility, not the chat. We won't be answering those. Go to the Q&A, post your questions there, and we'll get to answer them. And we've also got a couple of other resources and one or two other surprises for you at the end. But over to you, Nerina.
Right. Thanks very much, Carl. So yes, thank you for this opportunity. It is the start of a new year. It's often a good time for us to just reflect, take some stock, but also look ahead to the year that's ahead of us. And of course, this is also tax year end for many people. And so I always think it's a great opportunity for us to just review where we are in terms of our investment strategies, in terms of our portfolios, make use of the tax opportunities that are available to us. But today we really want to focus specifically on sort of the 2025 year ahead as we see it. And I'm going to try and keep it relatively simple and brief. I'm really just going to focus on 3 investment themes that we think really would be driving a lot of what happens in markets, but also maybe to give our listeners an idea of what are some of the more important things to think about and to look out for. I'm then going to expand on a topic that you and I covered late last year, which was this idea of building an investment portfolio using the core and explore method. And that I think will hopefully also give listeners a chance to see how do they actually implement using ETFs and in fact exchange traded products, the more broad-based ETPs, alongside maybe other investments that they already have in their portfolio. And then, as I said, we'll go and have a look a bit at the actively managed ETF scene, but specifically the multi-asset or the balanced fund portfolios. And then, yeah, you and I will have a bit of a chat. So let's get straight into those 3 investment themes for 2025. I think for me, probably the most important one to start off with is this idea that we are moving from an environment of enhanced geopolitical risk in 2024 to one where the big risks really are now geoeconomical in nature. If you haven't heard yet that about half the world's population went to the polls last year in national elections, I think you were stuck under a rock somewhere. This particular graph that I'm showing was actually what was expected at the beginning of 2024. So you see numbers in the region of the early 40%ers, but then we still had some unexpected elections even during 2024, meaning that over half of the world's population actually went to the polls in 2024. And probably the most impactful year in terms of that, where in around 3 out of every 4, 75% of those elections, we actually saw a change in the incumbent government to someone else. Clearly, voters, citizens giving their governments a very strong message to say, we're not particularly happy with what you're doing or how you're doing it, and we want change. Now, change is exactly where this comes in, because why do I say now geoeconomic risk in 2025? Well, when you look at the world and the way that it's shaping, we now know what the outcome of those elections were. But we don't quite know yet what that means in terms of policy changes, what that might mean in terms of the global trade environment, markets, economics, and so on. And I think we're experiencing a lot of that at the moment, with Trump literally coming out with several executive orders a day, and a lot of countries responding also to that. There's definitely a big game of chess going on in the world, and I think it will still take some time for a lot of this to sort of filter through. We might see some of these policy changes come through, but we still don't actually know what that will mean for economies, and most importantly, what it will mean for markets. So what does that mean for us in terms of our investment portfolios or our strategies? Well, we believe that certainly it increases uncertainty. And how do you best account for increased uncertainty? Well, you certainly do that through well-diversified portfolios. We've had an exceptional run in markets over the last 10, 15 years, and certainly 2023 and 2024 for many people were 2 back-to-back exceptional years, especially when you were invested in the US. Now is a time not to go and chase that next shooting star. For us, this is much more about wealth protection, to keep what you made. And that's often hard when you've got this idea of you're always interested in what's happening and where do I go and so on. We do believe that wealth protection is really an important one. Because I think one of the things that we're going to see is that Trump certainly may control Congress and he may control the House, and he's certainly bullying his way around the global arena, but he can't control the economy and the markets. And he's really, at the moment, weaponizing the exceptionalism of the US. And we've seen some countries push back in terms of this. So as much as we expect that US will continue to be this exceptional market, that will certainly remain for us. I think what we do need to acknowledge is that we've made a lot of money. Let's try and keep as much of that and not just give it all back because of ill-considered moves. The next theme for me really is this one of tech. I mean, tech is a very large and broad term that really covers, as I say, it covers here, it covers there, it covers absolutely everywhere. And tech certainly is not just the Mag 7 companies, it's certainly not just AI. Think of the application of tech in so many other industries. Think of fintech. Easy Equity is such a great example of the application of technology in financial services. Think of health tech. Think of the use of technology in healthcare innovation. But think big data, metaverse, robotics, the list goes on and on. So I think there's so much around the tech theme that if we say, I want to invest in tech, really, what I want to say to you is you don't have to go and look for it. You already have it. Because as things stand at the moment, certainly the US makes up more than 75% of the MSCI World Index, in other words, of developed markets. And even when we look at the broader all-country world index, so including emerging markets as well, the US effectively gives you around 70% of that. And then, of course, we know that the Mag 7 dominates the S&P 500 largest companies in the US. So just by being invested in either a global ETF or index or in a S&P 500 index fund, for example, you already have a lot of tech. So one word of caution would be to say you certainly don't need to go and aggressively add to that exposure unless you feel that there's a very specific tech exposure that you feel confident about, that you feel comfortable about, that you want to specifically add that. But be careful not to what I often refer to as diversification, thinking you're adding things to your portfolio, thinking you are diversifying it, but actually you're just making things worse. So tech, I think, is a really important one. It will continue to drive the US. It's going to continue to drive corporate profits. It's going to continue to keep the US exceptional, certainly for the foreseeable future. But don't worry, you're already involved. You're already invested. You already have a long. So the final theme for today, higher for longer. What do I mean when I say higher for longer? Well, probably the first one when I show you that horrible little sticky graph, that's about inflation. We've come through probably one of the most extreme inflation periods over the last 2 to 3 years, with inflation around the world spiking to exceptionally high levels. It has come down from that, but certainly we can't expect inflation to return to the levels that we experienced. And here I'm specifically talking about developed market inflation, unlikely to return to some of those levels. Why do I say that? Well, certainly some of what Trump is doing is going to cause inflation, but not everything that he's doing is going to cause inflation. Think, for example, of a lot of the, the DOGE, the government efficiency, the cuts in terms of jobs, the stopping of aid, a whole lot of things. He's creating what hopefully will actually be efficiency in the system that might actually suggest more tax cuts could be afforded. But those tax cuts go back into the system, and when people have enough money, or maybe even too much money, it chases too few goods, and you actually end up with an inflationary scenario. So what do we know from very recent experience? What happens? Well, it means that interest rates stay higher for longer as well. Later today, we will have the interest rate announcement from the Fed. The expectation is that they won't move this time around. Now, bear in mind, a year ago, if we were doing this a year ago, we probably would have said, oh, we're looking at probably 6, 7, 25 basis point interest rate cuts from the US. As the year progressed, those expectations were pulled back significantly to the point where there are now even some market pundits that say, that maybe we won't get another cut in the US, maybe one more, but maybe the next move by the Fed is even up. And you might say to me, oh, yeah, no, but Trump wants lower interest rates. Well, Trump might want it, but Trump doesn't always get everything that Trump wants. So we're certainly going to see the Fed, and I think the message that they give this afternoon around the decision, I think is going to be very important to watch. What about our own interest rates in South Africa? Well, tomorrow we have our local SARB MPC meeting with their announcement. And there, the expectation is actually that we will get a 25 basis point cut, which will be quite interesting because it will be the first time that we'll actually see a slight narrowing of that interest rate differential between South Africa and the US. So we'll continue to watch this one very carefully. For us, the strategy around this really is that it means that there's still some great opportunity to be had in interest-bearing investments. And in fact, that is one of the ways in which one can certainly go a long way towards protecting some of the wealth that you've generated with equity investments in recent years. High yield bonds, in other words, corporate bonds in the US, but also your emerging market bonds, such as South African government bonds, remain attractive. And you know what? When interest rates are relatively high as they are at the moment, might even be a time where cash is king for a while. But let's move on to now actually building an investment portfolio. And what do we mean when we talk about this core and explore method? So the core methodology really says in the core, you start with a portfolio which is multi-asset, balanced, very well diversified. And so, Carl, you alluded to the ETFSA Balanced Foundation Prescient Actively Managed ETF that we launched last year. Share code ETFSAB. We were joking in the office to say we're actually bringing breweries. Those of you that are old enough, like Carl and I, will remember that the share code for SA Breweries, when it was still listed on the JSE, was SAB. So there we go. ETF SAB, beer is back on the market again, but this represents a great diversified core holding in a portfolio. And what do you get when you buy such a multi-asset balanced fund portfolio? Well, you get, as the name suggests, multi-asset classes. You get equities, you get interest-bearing, you get property, you get local, and you get global. So with a single investment, incredibly cost-effective to buy just one ETF, you're really getting just about everything that you might need. But now some of you might look at this and say, nah, that's not quite what I need. You know what? I hear what you guys are saying. I hear that people say the US market is exceptionally overvalued, etc., etc. I'm not comfortable with this risk. And Arena, I heard what you said in terms of I need to protect my wealth, preserve my wealth. So you know what? I want to dial down the risk that's already in this core portfolio. Now, how do you dial down risk? Probably the most obvious way for many people is just to add interest bearing. Whether it's cash, so the PIP ETF, for example, a money market ETF that we've got, or something like the Satrix Govy, government bonds giving you a very high coupon rate, nice interest, certainly a way to reduce the overall risk of your portfolio. But another way to dial down risk would be to say, well, I'm going to focus on shares, equities that actually pay high dividends. In other words, a bigger proportion of their return actually comes from dividends. And I know there are many in the easy community who really focus a lot on dividend investing. And I think it's a great way also, not just to diversify a portfolio, but also to support the returns that you get from equities. So certainly we've got the Satrix Divvy that will give you local dividends. You've got the 10x Global Dividend Aristocrats ETF, the GLODIV, that's going to give you global dividends. So great opportunities to add dividends to your portfolio. Another way to dial down risk is actually to say, you know what, I'm going to go for that traditional, age-old, precious metal, in particular gold, physical gold in my portfolio. We already saw a lot of that in 2024, how the inclusion of gold in a portfolio provided not just very good returns, but really that risk stabilizer. I always called gold the thing that zig when everything else zags. And so that certainly would be a way to also dial down risk in the portfolio. Or another form of real assets, physical things. Property, listed property. And again, we've got local and offshore opportunities. Some of them are quite vanilla, just plain pure index trackers. Others are a little bit more unique. But see the real assets, the property investments in particular, really sort of continue. We saw some of this coming through in 2024, and we expect that that can continue. Great diversifier in a portfolio. Others on this call might look at this and say, oh my goodness, this is boring as hell. Please, I want to dial up the risk. I want a lot more risk in my portfolio, either because I've got a brilliant long time horizon, I've got a lot of risk appetite, I've got a lot of risk capacity. So how would you dial up risk in a portfolio? Well, one of the ways to do it is to actually add something which has got a low correlation to the sort of traditional vanilla indices or portfolios that you've got. We refer to it in finance speak as low beta. So something that is still equity investments, but it looks quite different maybe than certainly your Mag 7. So here you would look at things like maybe healthcare or even infrastructure investments and so on. So you're adding to some of the risk, but you're doing so in a relatively contained risk way, a low beta way. Others might say, no, I want high beta. I want those things that move a lot faster when the market moves than the sort of the main market moves. So they would go for more specific tech exposure. Or maybe things like renewable or transition energy. You know, when we look at the transition energy, and it's actually quite interesting to see this link between the demand for AI data centers and a lot of that, how energy hungry a lot of those. So we certainly see alongside this tech theme, this growth in AI, also the need for renewable and sustainable energy sources. And in this space, for example, one might look at things like nuclear, for example. There's some certainly on the global market, there's some nuclear ETFs that one can invest in, or even uranium, you know, as a specific commodity. So certainly ways that one can add quite a bit more spice to your portfolio. But another way to add diversification on a higher risk sort of basis to the portfolio is to focus on specific sectors or specific investment styles or specific regions. There are many out there who feel that emerging markets have been such a laggard for 10, 15 years now, their time has got to come. So you might want to add specific emerging market exposure in addition to the core that you've got. You might want to go for stocks that exhibit high momentum, for example, or a particular sector like financials or resources or whatever. So these are all add-ons that you can add to your core portfolio. And probably the highest risk of all of them, but the one with potentially the most interest for people that do like to watch the markets, is to have a portfolio of individual stocks alongside this core, this relatively boring but very well diversified core portfolio. And whether those single stocks are local stocks or whether they're global stocks doesn't really matter. It gives you the opportunity to supplement, to explore beyond the core of the portfolio, which is really just that global balanced fund portfolio, the multi-asset one as we have it. Which then brings me back to that idea of the core, coming back to the idea of a multi-asset balanced fund, and specifically then actively managed ETFs. Because what does actively managed actually mean, especially when we look at it in the context of balanced funds, but even beyond that? Well, actively managed really just means that you're not tracking an index. So you are not replicating an index in what you are doing. That's the first definition, interpretation of actively managed, is you're not replicating an index. But if you are now investing in a multi-asset portfolio, a balanced fund portfolio, there are no generally accepted multi-asset benchmark indices. You know, there's no top 40 index for multi-asset portfolios, or an S&P 500, or even an MSCI World, for example. So if there's no benchmark index, what index do you track? And so if you can't track an index, then you necessarily get classified as an actively managed fund. Now, when we're talking about an actively managed balanced fund or multi-asset fund, it could mean that your asset class exposure could be static or strategic, or that can be changed actively. And we're going to look at some examples shortly. So you've got these two options in terms of your asset class exposure. But furthermore, within each asset class, so within SA equities, for example, or within global equities, those underlying holdings could also just replicate headline asset class benchmark indices, or those underlying holdings could be actively managed. So you see that this idea of active management theoretically gets introduced in two possible levels of that portfolio construction. And here I really want to highlight three specific things to our listeners in terms of what do you need to check before you decide to invest in such an actively managed product. The first thing that you want to check is to say, what is the objective of the fund? Does the fund objective align with my investment requirements? So look at that first. Please don't go and look at past performance. Go and look at the fund objective and see whether that talks to your investment objective, your requirements. The second one, which is always an important consideration, but even more so when we talk about actively managed products, is to check the costs. And the terms that I use there, TIC stands for total investment charge, TER, the total expense ratio, and the important one here is the TC, which is the transaction costs, because the transaction costs is going to reflect the level of activity that you have in the portfolio. So the more active trading that takes place inside the portfolio, the higher that transaction cost will be, and therefore the higher the overall cost would be. And you need to be comfortable that the level of activity in the fund, and therefore the higher cost, is sufficiently compensated for by the higher return that you can get from such an actively managed fund. And the final one, which I think in this context is just as important, is the disclosure policy around the actively managed ETF. Because according to the JSE listing requirements, there are 3 different types or levels of disclosures. It can be fully transparent, meaning that you can, at any point in time, on a daily basis, see exactly what is being held in that portfolio. Could be semi-transparent, so they disclose it occasionally. Typically, that might be on a monthly basis. Or it could be non-transparent. It's like, well, you know what? Just trust me. I know what I'm doing. I'm not going to tell you what I've got in my fund. Just trust me. And why is the disclosure or the level of transparency so important? Well, think about it. If you're using such a multi-asset fund as the core of your portfolio, if you don't know what's in it, how do you know what you're adding and whether you're not maybe duplicating or overemphasizing certain aspects? So transparency and disclosure is incredibly important in the core of such a core and explore portfolio. So the concepts of strategic asset allocation or tactical asset allocation is really the decision in terms of how much we're going to have in the particular asset classes. Both of these, in that orange overlap in the middle, they give you a lower level of risk because you are dealing with a multi-asset portfolio, a balanced fund portfolio. So a lot of diversification already included in it. But the strategic asset allocation is going to say that the allocation, the exposure to each major asset class will remain unchanged over time. So as an investor, you know exactly how much SA equity am I going to have, how much SA bonds will I have, you know that in advance. And it's great for a long-term investment horizon, and it's often also a great one for newer investors or investors that don't necessarily feel comfortable making those sort of decisions themselves. Tactical asset allocation would have a fund manager that decides how are we going to increase or reduce exposure to certain asset classes. And this is where you'll hear fund managers say things like, oh, we are overweight global bonds, or we are underweight Chinese equities, or whatever the case might be. So that means they've got a tactical position away from the strategic or the static benchmark weights. In that case, what you certainly need is more investing expertise. And so typically a tactical asset allocation model would be offered by a professional institutional fund manager. And you'll see on the next slide, we've got a couple of those available in the market as actively managed ETFs on the JSE. So let's maybe just summarize this sort of in terms of the asset allocation that can be either static or strategic, or it can be variable, tactical in other words. But then also in terms of the underlying asset class exposures, are they index tracking, this so-called passive, or is it actively managed, so-called active? And so, yes, the ETFSA SAB, the ETFSA Prescient Balanced Foundation portfolio is a static asset allocation, strategic in other words, and the underlying holdings are also passive or tracking indices. So at any point in time, you will know exactly what you have in that portfolio. We have a few others on the market that fall into this category. So the Satrix multi-asset products, the growth and the protect portfolio, they've been around for a long time, used to be offered by APSA under the New Funds brand, but that is only SA equity. So you're not going to have any global equity in that. And similarly, one of the most recent ones that was listed late last year by Satrix is the Global Balanced Fund that they've got. And as the name suggests, it's only global. So yes, it's multi-asset classes, but only global. And none of those 3 are actually actively managed. The ETF SAB is the only actively managed one in this group. But then we do also have the Aqua which is the Numero Aqua Global Multi-Asset Actively Managed Portfolio. And in this case, they actually follow a tactical asset allocation strategy. In other words, they would vary the exposures to the different asset classes over time based on their macro view, their top-down view. They would be overweight certain asset classes, underweight others. But when they then implement those asset classes, they still make use of index tracking products, mostly ETFs, to give effect to those underlying ones. We've actually got no static asset allocation, actively managed underlying portfolios. But of course, on the tactical side and on the asset allocation side, we do have the easy BF, the easy equities, or the easy ETFs, I'm sorry, balanced fund. And we also do have the COG cap, the COG man, the co-opti, wonderful names. Those are three coronation multi-asset balanced fund portfolios, actively managed portfolios that they launched, I think it was in October last year. And as with the Satrix one here also, it's only global. So between the ETFSA, the Aqua and the EasyBF, those are the only multi-asset, local and global balanced fund options that you have available in the market. And so I just want to reiterate, what are the pros of having a so-called passive exposure? Well, because your exposures are static at asset class level, you know exactly what you've got. So if you now want to follow the core and explore, add your own exposures to it, you know exactly what you're dealing with in the core. It doesn't change. Using the index tracking underlyings means also that the underlying cost is certainly a lot less than it would be in an actively managed portfolio. So the potential disadvantages of the active one, and it's not necessarily disadvantages, but it's maybe just a warning to say, be sure to do your homework. Make sure at any point in time that you actually know what's inside that fund to ensure that it is still consistent with your investment exposure. And if you are following the core and explore model and you're adding to it, make sure that what you've got in the core and what you're adding in your petals of your daisy doesn't actually counteract one another or override, or maybe in sort of the law of unintended consequences, that you are overexposed to an area that you weren't aware of prior to the fact. And Carl, that really sort of covers I think the main points that I wanted to share with the audience today. So very happy now for you and I to have a discussion, to answer some questions from the listeners. Over to you.
Great. Thank you so much, Nerina. Yeah, there are definitely a couple of questions, and I've got a few things. Maybe we must stop your presentation and we'll just have you and
I
me.
will do that. There we go.
But and this is definitely not flattery because, but I get goosebumps listening to you, because one of the things I love is education and giving information to retail investors, because you've seen this over decades. We've seen this at Easy Equities. Retail investors are smart, and getting information from you, from others, reading, listening, discussing, and then making your own decisions, knowing why you're buying something, why you're not buying something, is so vital. So yeah, I really appreciate your time and all of that information. So I'm going to jump straight into questions. But before I do, this presentation will be available on the Easy Equities YouTube. And it will also be on blogs.easyequities.coza. And we'll put links to the various ETFs that Nerina has mentioned. So that will be available on there. And Nerina, a couple of people are just with us for a short while now before they go back for lunch. And so I also just want to do a few other things. Unplanned, but you're used to that by now. And luckily, as I said, you're so eloquent. The first thing that I want to do, which is completely unrelated to this, is you've got a colleague called Gareth Stobie, who is also well known to many people here, has been in the industry for a long time. Gareth Stobie lost a very close friend of his who was diagnosed with a brain tumor recently. And what we've done from the Easy Equities community perspective, Nerina, we are making the charity that Gareth ran the Comrades for, which was the brain tumor. I think it's just called the Brain Tumor was the charity. That's going to be our Donate for Good charity. So the community will be donating to that in memory of Gareth's friend, and Easy Equities will be matching the amount that's raised in the month. So you guys can keep an eye out for that. But we wanted to say thanks a lot for what Gareth is doing.
Thank you very much, Carl. I think it's very, very well received, and I know that Gareth will be absolutely thrilled to hear this. And just so people know, that charity, all of that donations go directly to research on specifically brain tumors. So it will be very well spent, especially in the light of Trump cancelling, a lot of the research grants that go to other countries. So thank you to the Easy community.
Yeah, they've been legends. They've raised, millions for, I think, about 50 charities now and organizations. So it's been wonderful. So back to topic under discussion, Arena. Costs. We've had a couple of questions around costs. Now, you spoke about what people should look out for. Maybe you can talk a little bit about your TC that you mentioned and the activity. Is that disclosed? So the manager, how often they will be in and out of a position.
Yeah. So, Carl, according to regulations, we are actually not allowed to disclose any costs until we've got a 12-month history in terms of a product, which I think is very frustrating for investors that are not just cost conscious, but that do what we love them to do, and that is to do their research, lift the hood, and actually check underneath. So it's quite frustrating. You will see for many of these products that were launched over the last year, very bland looking so-called MDDs, minimum disclosure documents. So that we're not allowed to literally to disclose that. The next thing to look for is that many of these ETFs are launched with a management fee already disclosed, but even the management fee does not give you the full total expense ratio. The total expense ratio would, for example, also include the cost of any underlying investments that you might have in there. So it's very, very difficult for investors to get a true sense of the costs until a year has passed. So certainly from ETFSA side, we are trying to communicate as much as we possibly can. So for example, when we launched the ETFSA at the time, we estimated that our total expense ratio would be no more than 0.52%. Everything included. I can tell you that on a run rate at the moment, we are definitely below that. But as I say, regulations won't allow us to disclose that. But I think for a starting point, investors should at least look and see what is the management fee. And the second thing is to consider what is the level of activity. If the strategy of the ETF is one that trades quite frequently, just expect that your TC will be higher than it would be if there's no underlying or regular underlying trading. And I think that's something that one can at least gauge. Don't be fooled by the fact that there is actively managed in the name of the product. That's why I emphasize that this is just about not tracking an index. Go and read about the strategy of the fund and get a sense of how actively is it actually being managed.
Yeah, great advice. And also, if you don't understand the strategy, also what you said earlier, then don't invest. Make sure that you understand
Yep,
the strategy and that you're
absolutely.
comfortable that it suits your investment goals. Rena, I
Yep.
think the other thing to clarify, so that's the cost of the actual product, so the actual ETF, actively managed ETF that somebody would be buying, but also where you're buying that would have costs. And now I know, Easy Equities prides itself on disclosing that. We've got easyequities.co's pricing, ETFSA, certainly very clear on the pricing, but users should also look at where they're buying these products and what the cost of that is. And is that a monthly cost, an annual cost, etc.?
Yeah, absolutely, Carl. So I think there we normally try to differentiate between an annual cost, which is often things like, sort of the admin fee or the account fee or having the account open. And that's often expressed as either a percentage of the size of your portfolio, or in many stockbroking models, it might actually be a fixed fee. So, if it's 150 Rand a month, for example, if you've got a R1,000,000 portfolio, you don't even notice it. If you've got a 5,000 Rand portfolio, then 150 Rand a month is going to be quite a lot. So check those costs also in the context of the size of the portfolio. But then the other very important cost is your transaction cost, because that is an event-based fee. You only pay that as and when you trade. So that would go to your own activity levels in terms of, do I run a monthly debit order? Do I trade the hell out of my own portfolio? Make sure that your own level of activity is matched by not just the cost that you're incurring, but the value that you're adding through your own level of activity.
Yeah, good point. Just while we're talking and taking the questions, if you guys want to win 100 Rand into your Easy Equities account, we're going to do this for 5 people. Please go onto X and tag ETFSA and tag Easy Equities, hashtag Easy ETF, and tell Narina what your favorite ETF is. ETF, active ETF, doesn't matter what your favorite one is. We won't just describe what favorite means, just what your favorite one is. So on X, tag ETFSA, tag Easy Equities, hashtag Easy ETF, and tell us what your favorite ETF is, and we'll put $100 into 5 people's accounts. And you've got until, let's say, 1:30 to do that. And then Jonathan of our social media team will do that. Narina, next question relates to retirement RAs. Can we hold actively managed ETFs within an RA? And if we can, is it a good idea or not?
Great question, because Carl, we so often get questions around retirement products and specifically RAs. Now, the theory says that absolutely you can hold it in it. And in fact, both the ETFSA Balanced Foundation ETF as well as the Easy BF Foundation ETF are both also Reg 28 compliant, Regulation 28 compliant, which means that as a standalone product, it qualifies to be used in a retirement fund, even if that's the only thing that you hold. The problem is most retirement annuity funds don't allow each individual RA member to choose their own underlying products. And this is not because they don't think you don't have the ability to make those decisions or whatever. It all comes down to the regulatory requirement of the RA fund, who needs to ensure regulation compliancy, so the Reg 28 compliancy on a daily basis, every single day for every member. And the cost to have the admin platform assess that just is not worth it for most people. So I know a lot of people would love to choose their own products for their retirement annuity funds. There are a select few platforms that do allow it, but those are typically for significantly larger RA amounts. So for the majority of people on the call today, I would assume that you would become a member of a retirement annuity fund, and the retirement annuity fund might offer one or more such underlying funds, and that could be held in that. In fact, on the ETFSA Retirement Annuity Fund, our wealth default portfolio is actually exactly just the ETFSA Balanced Foundation Prescient AMETF. So the answer is yes, but it might not be so easy in practice.
Right, thank you very much. Of course, from an easy perspective, or easy equities, we think it's easy because you can do it on the platform, and people just go wild with your ETFSA product and our easy ETF ones, government bonds. There are a whole bunch of products that you can choose in your Easy RA wallet. And I mean, Arena, we are all passionate about saving in retirement. I actually don't like the word saving, it's investing in your future. And I think this is good. Crypto. Is there crypto in these actively managed ETFs? Are we missing out because crypto is where we should be putting all our money and not wasting it on these ETFs? What are your views on crypto?
So let maybe start with the last question. My views on crypto is that I think that it is absolutely a technology that is here to stay. It is much like the tech theme that I spoke about. Actually, the crypto from the perspective of distributed ledger technology, in terms of the technology, is already around us everywhere. So we have it. In terms of investing in crypto, so-called currencies, I'm going to differentiate between crypto assets, but let's stick to cryptocurrencies, because let's face it, most people are actually just wanting to know about Bitcoin. The fact of the matter is that it's just now gone a year since the first Bitcoin ETFs became available in the US. A few other markets were already quick off the mark before that, but as it stands right now, we don't have them available in South Africa just yet because our regulations are not quite there yet. We've seen significant progress from the FSCA. So, you know, the crypto asset service providers is now a licensed category. So we have the ability to give advice, and ETFSA is actually one of the licensed crypto asset service providers. So we're allowed to give investors advice on these, and we can facilitate intermediate investments in foreign markets. But if you are trading on the local exchange, on the JSE, they are not available. I'm sure they will come. I just can't tell you exactly when, but watch this space. I'm convinced that we will see this in the sooner rather than later, I might say.
Yeah, I agree with that. Narina, are you guys going to be launching more products from an ETFSA perspective in the coming year? Can we look forward to that?
So Carl, for us, it's not just about just dumping product on markets. For us, it would be about where we feel not only that we are serving a client need, but where there's not something similar available in the market. So when we launched the ETFSAB, it was actually the first fully proper multi-asset balanced portfolio. EasyBF followed a few months later, but at the time it was the only one. There was no such ETF available on the market. So we're not going to rush out and just bring product to market. And if we do, it will be a similar sort of look and feel, if I can put it that way. In other words, solving client objectives, solving a client need rather than just trying to bring a product to market. We thought that we still believe that the balanced portfolio is an incredibly strong first investment for most investors, but because it was exclusively available to the RA, ETFSA RA community, we wanted to make that broader available. We have a couple of others that might also fit that bill. We don't have any specific plans at this stage, but if we do, it will be about solving clients' needs rather than just, piling product on the market.
Yeah, excellent. Rena, I want to ask you, and there've been a couple of questions around this on dividends. Now, one of the services that you provide is you often post dividends. Kayla works with us, doesn't want to listen to anything unless it's got the word small cap or dividend. But tell us how that works. Last day to trade, maybe just a bit more information, please.
Okay, great stuff. Yes. So just like shares, ETFs that do pay out dividends would declare their dividend announcement via SENS, the stock exchange news service on the JSE. So such an announcement would typically tell you how much you're going to get. In other words, the cents per unit that you hold. It would tell you a couple of salient dates. So the first one would be the LDT, which is the last day to trade, which basically says if you hold it by the end of that business day, you will qualify for the dividend. If you don't hold it, tough, then you don't get it. The next date is the X date, which is, as the name suggests, the date on which is excluding that dividend. And it is always the very next trading day. And then for many people, very important, the payment date. When am I actually going to see the cash flow coming into my account? And yes, most of our ETFs do follow a quarterly distribution cycle. There are some that do twice a year. Signia, for example, all of the ETFs only pay twice a year. And there are a few of the other global ETFs also that only declare and pay twice a year. There are some that's only going to be once a year. These coronation ETFs, for example, will only declare once a year. Then we've got things like, for example, that PIP ETF, the money market one, monthly. It pays out monthly. So have a look at the distribution frequency. That's the first thing that you want to check. But then the other thing to check also is whether this is actually a distributing ETF or whether it is a so-called total return or accumulating ETF. If it is a total return ETF, it means you will not receive the cash flow in your account. You're not going to get that money. That doesn't mean that the ETF didn't pay dividends or didn't declare dividends. But what they do is they declare it, immediately take that money, take it back into the fund, buy more underlying shares or assets or whatever they might be, and in that way increase the net asset value, in other words, the price of the ETF, but you don't actually get the cash flow into your account. Now, for those that are keen on dividends because they actually like to see that ka-ching coming through on their account, I'm sorry, guys, you're not going to get that sort of endorphin boost to hear that coming through. But from a cost perspective, especially if you're a relatively small scale investor and the rand amount of dividends that you receive are relatively low, your cost to reinvest those dividends can actually just kill the whole dividend flow that you get. And we are huge fans of compounding. We want people to compound, reinvest those distributions. So in that case, a distributing ETF is not the way to go. You rather want to be invested in one where they actually do that reinvestment on your behalf. I saw that there was somebody that sort of said, so what happens on the X date? Does the price drop? Absolutely. So all else being equal, on the X date, there was no change in the value or the price of the ETF, that price would drop by the dividend amount. Typically, we don't see it on most of our equity ETFs because the quarterly distribution is relatively small, but you go and check out some of those bond ETFs, those high interest bearing ETFs, and you actually see that the property similar. Sometimes you actually see that and you think, my goodness, why did my ETF fall by so much? Well, you're getting the cash as an inflow into your account. So your total value has not been affected, even though the price might have fallen.
Yeah, very, very interesting. Narina, I've got a couple of questions about investing for my grandkids. Where should I do so? Is, this best? I'm a young professional. Is this too risky, high? And I want to lump all of those together in terms of, you can't give that advice, and that's not the role here. But it is around, and I'm putting words in your mouth. You can correct and add, but it is around education. It's understanding your own individual risk appetite, your own investment horizon and needs. There isn't one answer that suits everybody. And so the best thing to do is to look at those minimum disclosure documents. To get the information. This webinar gives you information. Easy Equities has got wealth, but check it out, and then also trust yourself. Retail investors are smarter than they often think, to my mind. Are you happy with those words I've put in your mouth?
So, Carl, yes, nothing that I can fault in terms of that. I think what I would maybe just add to that, and which is not, as you say, advice, but rather just general guidelines, because we often get, and I'm now a grandmother myself, so I'm allowed to speak
Nice.
as a grandmother, you see. So when you want to do an investment for a grandchild, and I think it's one of the best investments that you could possibly do for your grandchild, we certainly prefer the tax-free investment accounts for those purposes, provided that you are doing this for a long term. So this is about starting your grandchild on their journey of building their own wealth, creating their own wealth. And I love what you say, we're not saving for retirement, we're investing. This is about planting seeds that will grow into trees that will one day carry fruit that we can eat. That's what long-term investing for me is all about. And I do think that having, starting your grandchild on such a journey might add, with the understanding and the agreement of the parents as well, it's a great one, not just to start them on their actual money wealth journey, but also on their education journey. Because as they get older, you can talk to them about investments. Look at what it's doing. Where is my money going? So it's an incredibly potent tool to really further this drive that we're jointly on in terms of investor education. But I do think what is quite important is that grandparents must understand that the legal guardian, which most likely would be the parent, does remain in charge of that account from the perspective of they actually have the legal oversight over that account. So that's why it's so important that as the grandparent, you have those conversations with your child or your in-law or whatever the case might be. And the other thing that's also really important to understand is the day they turn 18, that grandchild of yours actually gets control of that account. So make sure that you accompany this wealth building journey with the education journey as well, that they don't cash out the account the day after they turn 18 and all of your good intentions come to nothing.
Absolutely. A couple of questions around where people can buy. Just to mention that all the products that Narina has mentioned, so particularly the ETFSA actively managed one that we spoke about, but all the products that Narina mentioned are available on Easy Equities, and some of them in multiple wallets. So some of them in ZAR and TFSA and other wallets, but they're all there. And as Narina said, they're already, I think you said $500 million since launch. Narina.
Yeah, over. Yeah,
Absolutely. Check
absolutely.
it out. Here's an interesting one for somebody who's wanting to add a little petal that is a Bitcoin ETF. Now, people can be buying these in their USD wallets on Easy Equities. Now, if somebody's wanting to add, as they call it, their digital gold, their Bitcoin ETF, Narina, is that going to increase or decrease their risk?
Oh, I love it, love it.
The nerd question, I'm sure.
I love it that you mentioned almost as their digital gold, because that's exactly where the petal that I would add this into is it's almost a combination of those precious metals, but also a form of the real assets almost. You might say, how can I call a digital currency a real asset? But it really is, when we talk about the risk that is introduced to a portfolio by investing in something like a Bitcoin ETF, it is not only the risk, the so-called risk, which is really the volatility or the standard deviation of that standalone investment, but rather its interaction with the rest of your portfolio. And that is exactly why gold also has been a good diversifier, a good risk hedge, because when you look at the standalone volatility of a gold ETF or a Bitcoin ETF, yes, it is very high, but its correlation with the rest of a more traditional portfolio is very low. And the mathematical side behind this says that actually reduces portfolio risk. So there are several studies out there that show that adding 1 or 2% of your portfolio in a cryptocurrency ETFs, such as a Bitcoin ETF, actually lowers your portfolio risk rather than increasing it. Of course, if you go and put 80% of your portfolio, if your petal becomes bigger than your core, then you might have a problem. But a relatively modest amount into such one actually reduces the risk of your overall portfolio.
Great, thank you very much. Nerina, you need to fact check me here because you never make mistakes and I often do. But the ETFs, the SAB one, the ETFS AB, your product, it is available in your ZAR wallet and Easy Equities, obviously, but it's 99.9%. It's also in the TFSA, right? I'm not lying. It is in the TFSA.
It certainly should be, because maybe just for the benefit of the listeners also, the criteria for something to qualify for tax-free accounts for TFSAs is that there can't be any performance fees levied on that. So that was quite an important one, especially when actively managed ETFs were first introduced, was to check whether there's a performance fee or not, because actually in the legislation that introduced tax-free accounts, that was one of the criteria that you're not allowed to charge performance fees. And I'm happy to report that as we stand here today, not a single actively managed ETF on the JSE charges a performance fee. That even goes for those coronation products. Can you believe it?
I can't, but that's great. And I've just checked, it is available in the TFSA, so that's great. Nerina,
sorry, maybe just for, if I just further on that point. So one of the first actively managed ETFs that we had was actually the Signia iTrix, the FANG AI one, the Sci-FANG as it is now. And when it was first introduced, it actually had a performance fee in it, which meant it was not allowed to be used in TFSAs. And Signia has subsequently changed that. They removed the performance fee, and you can now buy the Sci-FANG in your TFSA.
Right. Nerina, there are lots of questions that we haven't gotten to. The team, Isha, that looks after our content, and some of our other team members will respond to many of those. But just as a blanket summary, if you haven't been to compare.easyequities.coza, you can compare various ETFs, their costs, and a whole bunch of the other elements Nerina spoke about. So compare.easyequities is a good one. Following Nerina and the resources that she's got in ETFSA is another good one. She's always active and always happy to engage. So follow Nerina and ETFSA on social media. But compare.easyequities.coza, good information. There are people asking a little bit about retirement. Again, if you go into Easy Equities, you can go to support.easyequities.coza, type in retirement. We've got a page that tells you about preservation, living annuities, retirement annuities, and all the products that you can buy in there. So please check it out. Those are all free resources. I mean, they're fantastic resources in this industry, and retail investors must just take advantage of them. Nerina, I'm going to give you a time to have a sip of water as we wrap up in 2 minutes. But I'm going to ask my colleague, David Oberholzer. He's not quite as big a fanboy of you as I am, but he is. David heads up Easy ETF, way younger than me and you, but completely passionate about actively managed ETFs. And I want to put him a little bit on the spot. So David, what did you think of Nerina's presentation? Good, bad, useful information? What did you think?
I always love listening to Nerina's presentations because it's difficult to find someone with that level of passion, not just for the product category, but education as well. And the nugget of wisdom that I've been dying to find that you kind of know, but great now to hear Nerina say, is the TFSA qualification criteria around fees. So I loved it, and thanks for the information sharing, Nerina. Core Satellite, definitely, I think, great portfolio construction tool that can only benefit investors.
Oh, and David, your prediction for the year? Are we going to make money with actively managed ETFs? I'm going to hold you to this because I'm going to do what you tell me now, and I'm going to come back at you at the end of the year. And don't blame Trump for anything if it goes wrong. Am I going to make money?
No, I definitely think it's a product category that's going to grow and see more and more inflows during the year, and we're likely to see more products coming to market.
Yeah, absolutely. Well, thanks very much. You'll see more of David on our social media. He's going to be putting out a lot of content as well. And just back to you, Nerina, and to wrap up. I mean, as a category, there aren't hundreds or thousands of actively managed ETFs yet in South Africa. But do you agree with David? I mean, worldwide, what is the category? What is the growth that you foresee here?
Yeah, absolutely. So yes, it's relatively small still on the JSE, but it was the fastest growing category in 2024, and we don't see any reason for this to stop. In fact, I expect that there will be much more growth in actively managed ETFs than in index tracking ETFs. But having said that, I think it's important that we go back to the point that I made in terms of what does actively managed mean? It really just means you are not tracking an index. We spoke about balanced funds today, multi-asset portfolios, but when you look, for example, in the bond space or in the enhanced income space, that is an asset class where just following an index actually gives you relatively poor opportunities for investment. And we've got great actively managed products in that space. But I think the other really important one is that, like Coronation, I think we can expect to see a lot more of our traditional active managers come to the JSE with actively managed ETFs for the simple reason that it gives a different access point for that investment. So I don't want our listeners to think in terms of ETFs as being so-called passive or index tracking and unit trusts as being active. This is about the ET part of it, exchange traded. It's about where do you buy it? And we know that exchange traded products are really the unit trust sort of the 21st century. That access point bring efficiency, brings regulatory safeguarding to the environment that is not available in unit trusts, which are really just OTC products. You buy directly from the unit trust manco. So from that perspective, we've seen a significant shift in global markets towards listing investment funds and investment opportunities on exchanges and a move away from OTC or over the counter. And I see no reason why we will not experience the same in South Africa. And therefore, it means that as investors, we need to really become a lot more discerning and hone our skills in terms of how do I do my research? Where do I find my information? What do I look for? What are the important considerations before I decide to just buy an ETF? Because trust me, where we currently stand, 227 exchange traded products on the JSE, we've got more than there are investable shares on the JSE. So how you decide which of these to buy and how you include them in your portfolio is a critical skill for the retail investor to acquire. And I must salute Easy and the community in terms of what you're doing alongside us in terms of the education for investors, because this is what will determine. Carl, you asked David, are you going to make money or not? That is how, as an investor, you will make money, is if you do your homework, you understand why you buy something, because that will also help you to ride the volatile wave of investments that are invariably a fact of life.
Great way to end. Thank you very much. We'll have lots more education from David, from you and many others. Nerina, as I said, genuinely, you are the doyen of ETFs. I mean, you and Elena and a few others have done amazing things for the industry. You talk passionately, as we see, but so knowledgeably and generously sharing all the information. So very best wishes to you and the ETFSA team. If you're looking for the product on Easy, again, the code, you can just go to invest page and you can type in ETFSAB or ETFSAB, and it's there. And yeah, Nerina, as a grandmother, I hope you have a wonderful rest of the year with your family, Easy community. Enjoy the time with your family. Lots of exciting things on the horizon, and appreciate everybody joining us and giving up your time and investing in yourselves and your investment journey. On behalf of Nerina, ETFSA, myself and Easy Equities, we really appreciate it and wish you well on your journey. Thank you very much.
Thank you.